I'd like to introduce and invite to the stage Dennis Kelleher, the CEO and President of Better Markets, which is, as Christoph mentioned this morning, is Finance Watch's US cousin. Dennis has come over from Washington to be with us this week and is going to give us the message from a report from the US, I believe. Dennis.
Afternoon, everyone. As Martin Wolf laid out, we are at a crossroads due to slow or no growth. I want to talk about the enormous pressure that is putting on financial reform regulators and legislators, and about the financial reform debate more broadly and some of the key facts missing from that debate. While I will mostly focus on what is happening in the United States, much of what I'll talk about is broadly applicable to the discussion of finance and reform everywhere, including broadly in the EU. But first I want to say that it's an honor to be here at a Finance Watch conference. I want to compliment the European Parliament and the other founders for having the wisdom and foresight to create it and support it. Better Markets has worked with Finance Watch almost from the very beginning, and we know them well. Not everyone may know it, but Brussels and all of Europe are very fortunate to have Finance Watch. There's nothing wrong with the private sector pushing their self-interest and agenda, but it's imperative that you also get the benefit of a genuinely independent voice, a voice that provides substantive, professional expertise focused solely on the public interest. That's what Finance Watch does, and that's what Better Markets also does. When politics or public policy are overwhelmingly dominated by just one side, the outcomes simply are not likely to be optimal or desirable. For too many years, and even today, too much of the discussion about banks, banking, finance, jobs, growth are dominated by the biggest, richest, most politically well-connected, with the banks with the most bank lobbyists, allies, and campaign contributions, particularly in the United States. Economic might has too often overcome public interest right. While they almost always dress their self-interest in public interest clothes, the private sector is ultimately and always advocating for policies that help their bottom line. While it is no doubt that good public policy at times overlaps that of the private sector self-interest, it will always have an inherent conflict of interest. Regrettably, that self-interest and conflict of interest are too often overlooked, ignored, or falsely presented or denied. Unfortunately, that too often results in their voice being overweighted, indeed prioritized, too often at the expense of genuinely independent voices and those without such conflicts of interest. Now, don't get me wrong. I'm not saying that the private sector or the banks acting in their self-interest is a bad thing. Like everybody else, they're entitled to advocate for their self-interest, and when it comes to banking and finance, their input is often helpful and indeed indispensable. However, regardless of how it is described or presented, it must be seen for what it is. Private sector firms arguing for their self-interest to be reflected in public policy to help their bottom lines, business lines. That kind of one-sided debate is good for no one, not even the biggest banks themselves. Although I'll tell you, they don't see it that way or agree with me. Why is a more open, public, robust, inclusive debate even in the bank's self-interest? Because outcomes from a largely one-sided process lack legitimacy and are at best fragile and unsustainable, regardless of appearances, beliefs, or short-term gains. In addition to lacking a balanced discussion too often, another key problem with the current debate is that often when talking about banks, banking, and finance, facts, context, and history are ignored, wished away, or spun away. I refer to this as the fog machine, where massive amounts of money and words are used more to conceal than reveal. So let me mention a few facts that often go unmentioned and reference just a few key issues that we are all struggling with. First, the financial crash of 2008, with all due respect to Martin, was the worst financial crash, global financial crash, since the Great Crash of 1929. Only massive and ultimately unlimited bailouts amounting to trillions of dollars by governments and taxpayers in the U.S. and elsewhere prevented a collapse of the global financial system. Those bailouts prevented many, many more banks from going bankrupt, including Morgan Stanley, Goldman Sachs, Citigroup, Bank of America, and most of the other banks referred to as too big to fail. But for those bailouts, those banks likely would be mere shells of themselves today, if they exist at all. Although that was prevented, the crash and crisis still caused the worst economy since the Great Depression of the 1930s. In fact, it almost caused the Second Great Depression. It's astonishing to this day how often these basic facts are simply never mentioned or entirely absent from the discussion. That is extremely dangerous because without those facts, there is no context for the work and the need for financial reform and stability. Those facts are crucial for people to understand what you're doing and why. And importantly, what is at stake in the financial reform debate. Second, given those facts, no one should be surprised that the cost of the crisis has been and continues to be very severe, broad, deep, and long-lasting. After all, think of how long the damage lasted after the financial crash of 1929. That crash and its aftermath is regrettably the benchmark for our circumstances today. Better Markets did a study in September of 2012 of the cost just to the U.S. of the 2008 crisis. It showed that the financial crash and economic catastrophe that it caused is going to be more than $12.8 trillion. That study is available on our website, which is bettermarkets.com. That study was conservative and measured just lost GDP to the United States based on government projections available in 2012. The data since then makes clear that the ultimate cost of the crisis, again, just to the United States, will be much more than that, and certainly in the tens of trillions of dollars. That is almost assuredly true for the EU as well. And remember, those costs continue to increase, and they aren't just the obvious cost. For example, the unprecedented, unconventional monetary policy actions of the United States Federal Reserve Bank, and more recently, the ECB's actions, have been and continue to be a response to the economic calamity caused by the financial crash of 2008. Whether you agree or disagree with those actions, no one should forget that they are the ongoing response to the crash of 2008. And let's not forget those numbers, however large, indeed almost unfathomably large, are just numbers. They can never reflect the human suffering of the tens of millions of our neighbors who lost their jobs, homes, savings, and so much more, and yet very, very rarely mentioned in the debate. A third fact, when people talk about financial regulation or financial stability, too often the discussion has been redirected to focus on the bank complaints about the costs of regulation to them, without mentioning the cost inflicted on everybody else by the crash and economic crisis. As a result of this grossly incomplete discussion, the banks and their allies, especially in the United States, where I know best what the arguments are always arguing that regulations and laws should be subject to what they call cost-benefit analysis or test. That sounds nice, but in reality, it becomes an industry cost-only analysis, which fails to take the public interest and cost to the public into account. It's an argument designed to cripple reform regardless of how innocently it is packaged. Better Markets also did a study analyzing this tactic, entitled Setting the Record Straight on Cost-Benefit Analysis and Financial Reform. It, too, is available on our website. That study focuses on the misuse of cost-benefit analysis in the context of the regulatory agency called the SEC in the United States, but it's broadly applicable to this argument in any context. Fourth, and very importantly, the so-called choice between economic growth and jobs and financial reform and stability is a demonstrably false choice used as a weapon, importantly, not only to defeat reform, but to divide countries and regulators and pit them against each other. We hear it endlessly, the claims that regulation, reform, and stability will cost so much that it will prevent banks from lending and therefore slow growth and job creation, or they say things like it'll hurt liquidity. Not only is it not true, the available evidence, of which there is little, doesn't support it. By the way, isn't it telling how often the lobby makes claims that they don't provide facts, evidence, or data to support? Even when they are in the best position to provide that information, which often they uniquely possess. And remember, if such evidence exists and it supports their claims, they are also uniquely incentivized to provide it. After all, they'd likely win the argument. Therefore, from our point of view, the industry should always be required to provide proof and data to support their claims. Then those claims and the supposedly supporting data must be subjected to rigorous, independent, and ideally public scrutiny and analysis. If sufficient robust data is not provided to enable independent confirmation of claims, then the presumption must be that there is no supporting data or that the data doesn't support their claims. Unsupported claims, selective disclosure, or purchase studies based on undisclosed or incompletely disclosed data must be disregarded as unreliable, as would be the case in any other context. Regarding claims about regulation interfering with growth and jobs, history demonstrates just the opposite. As Martin briefly alluded to, after the Great Crash of 1929 and the Great Depression, banking and the broader financial industry was subjected to the heaviest regulation in the history of the world. The bank lobby at the time said it was going to kill growth, jobs, and indeed it was going to kill free markets and capitalism as everyone then knew it. But what really happened? About 70 years of growth and prosperity, and not only for the broader economy, but also for the finance industry, which flourished as well. No question there were ups and downs over those decades, but nothing like the crash of '29 or the Great Depression. That all changed after deregulation of the financial industry, which began around 1990 and peaked in 2000, at least in the United States, when the industry was almost entirely deregulated or subjected to, at most, light touch regulation combined with virtually no enforcement of the law or regulations. What was the result? In just a little more than 7 years after full deregulation, the world suffered the worst financial crash since 1929, the worst economy since the Great Depression. It's oversimplified, I admit, but you had about 70 years without crashes and only 7 years of deregulation causing the biggest crash since '29 and the economic catastrophe we're all still living with and Martin so brilliantly talked about. Financial regulation is often referred to by the industry as a job killer. But the facts show that deregulation is the real job killer and one of historic proportion. It's proof that regulation can be good for growth and jobs, and that the crash and the crisis was caused by too little, not too much regulation. Now, I'm skipping the issue of where on the spectrum from none to too little to too much. That's a much larger debate. But in terms of regulation being the job killer, that argument has been put to rest by the facts. In addition to being historically false, the entire growth versus stability debate has been framed by a series of false choices and false trade-offs, pushed largely by the too-big-to-fail banks and accepted far too uncritically by too many people. The false choices have been detailed by Robert Jenkins. He's a decades-long industry professional. He's a former member of the Bank of England's Financial Policy Committee. He's now a senior fellow for Better Markets. His short speech, a debate framed by fallacies, should be read and reread by everyone involved in this very damaging debate that falsely framed as having to choose between safety and growth. Importantly, he also destroys the arguments that governments have to choose between domestic financial stability and the competitiveness of their financial centers, which is to say, playing regulators and countries off against each other to create a race to the bottom has no actual foundation in fact, and it arises from a false framing and an uncritical acceptance of false choices. His speech can be found at our website also, and I encourage you all to read it. Fifth, deregulation is never truthfully and clearly labeled. It hides and masquerades as reform, jobs, economic growth, technical corrections. In fact, the legitimate and extremely important growth and jobs agenda has been hijacked by the self-interest of the bank lobby and is being used to conceal a deregulation agenda. I'll give you just one example from the United States, although I could give you many, many, many. But one recent example is a bill in the House of Representatives, H.R. 37, titled, quote, Promoting Job Creation and Reducing Small Business Burdens Act, close quote. So you got jobs, you got small business, you got burdens, what's not to like? In reality, it was a repackaging of 11 deregulation bills from last year, all straight out of Wall Street's wish list. You just change the label, you call it jobs growth. Isn't it telling that when these bills are put forward, almost nobody says it's good for business, whatever business it might be? It's odd that it's never mentioned how it might be important to business. And too often that's because they hide what is most important to them behind what is most important to you. They know that you desperately want jobs and growth and that the people of the EU and elsewhere desperately need jobs and growth. They also know that an accusation that something might reduce jobs or growth powerfully resonates with the people of the EU, the US, and everywhere else. And it's well known that such claims, however unfounded or unsupported, too often get media attention and repetition without scrutiny. Thus, sadly, jobs and growth have become a weapon and it's routinely used to advance a different agenda. It's therefore imperative, we say, that all such claims be met with caution, skepticism, scrutiny, and a demand for robust supporting data. Let me end by saying it must be remembered that sustainable, durable, and real economic growth and jobs will come from ending the finance-driven boom and bust economic cycles. Financial stability, transparency, clear rules, oversight, accountability, and the rule of law is the necessary foundation for achieving that. That's not just because financial crashes are devastating job killers. It's also because it's the only way to get the too-big-to-fail banks back in the business of banking and traditional lending that supports the real economy rather than high-risk trading and investments that threaten jobs and growth. Transparency and a level playing field is not only good for financial stability, it will also cause other firms to enter the markets, provide more services, ideally at lower costs, and boost the real economy. Just because a too-big-to-fail bank might not provide a service doesn't mean that it won't be provided. In fact, it's likely to increase entry by other firms into those markets and it's also likely that they won't be a systemic threat. Thus, if done right, big if, I admit it, financial reform and stability will result in more competition, greater industry diversification, lower prices, more jobs, and economic growth with much greater safety for the system as a whole. However, these actions must be done publicly and transparently with full disclosure to and full access by all stakeholders. Financial reform must be maximally inclusive because only that will enable public oversight and accountability, which will build public confidence. Being transparent and inclusive shows that you have nothing to hide and are being responsive to the public's needs and wants. Otherwise, public faith in elected officials, public institutions, and regulators will continue to decline and damage us all. Thus, it's not just jobs, growth, and financial stability that are at stake in this debate and the policy choices that are made, but the trust and confidence of the public, voters, and taxpayers are at stake ultimately. There's a lot more to talk about, but I've run out of time. So please go to our website for more information, and especially to read Bob Jenkins' insightful remarks on the false choice between growth and stability. Thank you for your attention.